Every time the economy generates a dollar of value, that dollar gets split. The portion that goes into the pockets of human workers, rather than the bank accounts of investors and owners, is the labor share of income. In early 2026, that split reached a historical tipping point. Workers received exactly 53.7 cents for every dollar of value added, the lowest level on record. This sits 3 cents lower than the year before the pandemic. In an economy of this scale, that 3-cent migration represents hundreds of billions of dollars no longer reaching payrolls. An adjustment this sudden usually triggers an audit. Analysts want to know if they are witnessing a genuine collapse in worker leverage, or if the data is being distorted by changes in how businesses report their income for tax purposes. If these records are accurate, artificial intelligence is entering a market where workers have already lost their footing. Before we can project the impact of automation, we have to determine if the ground really moved, or if the measurements were simply recalibrated. The primary argument for a measurement error stems from the 2017 Tax Act. That law created a deduction for pass-through entities, incentivizing business owners to reclassify their income. On paper, it looks like labor income vanished, but it may have just been relabeled as a profit payout to the owner. We can test this by flipping the equation. Instead of looking at worker pay, we look at the net capital share of income. Because these two shares pull from the same pool of value, a genuine decline in labor must be met by an increase in capital returns. To get an independent view, we can use the Census Bureau's quarterly financial reports. We'll look at profit margins in the manufacturing sector, a category that includes industrials, large portions of the tech, energy, and healthcare industries. The profit data confirms the trend. Following the pandemic, manufacturing margins stepped into a higher bracket. Filtering for the largest players, firms with over $1 billion in assets, the trend line is identical. The shift toward capital is happening at the top. The data suggests the shrinking paycheck is a reality. This isn't an accounting glitch or a tax-driven reclassification. It is a broad, systemic decline in the share of income paid to the workforce. We also have to ask if the economy simply shifted. If the U.S. is moving toward tech-heavy industries that naturally require fewer humans, the aggregate labor share would drop, even if individual workers weren't losing ground. But the breakdown shows otherwise. Only about a quarter of the decline came from output migrating between industries. A massive 74% of the drop happened within existing industries. Workers are getting a smaller slice of the same companies they've always worked for. This is the environment where transformative AI is now entering the frame. It is arriving in a labor market that is already structurally weakened. Macroeconomic models designed to predict AI's impact point to a future of extreme capital-labor substitutability. In a recent survey of 16 such models, 11 predicted that the labor share would eventually drop to zero as machines perform all production tasks. AI also exerts pressure through markups. Businesses are already using AI to power individualized pricing, using data to charge the absolute maximum a specific customer is willing to pay. This allows companies to capture more of the economic value, leaving less for the labor that produced the goods. AI isn't just replacing human tasks on the factory floor, it is simultaneously giving corporations more power to dictate prices, ensuring that a smaller fraction of revenue ever reaches the human workforce. When 3 cents of every dollar generated by the economy migrates away from workers, it changes the flow of global capital. That money moves from people who spend it on daily life to entities that largely hoard it. This creates what economists call the saving glut of the rich. Because capital owners and corporations have a much lower tendency to spend their income than workers do, this excess cash begins to pile up in the financial system. For the economy to stay in balance, this pile of savings must find an offsetting borrower. Another sector must take on debt. That borrower is the federal government, absorbing the income previously distributed to the workforce. The timing of this shift is visible on the national ledger. After the temporary volatility of the pandemic era settled, the federal deficit didn't return to its previous levels. Instead, it level shifted into a new norm of roughly 6% of GDP, a baseline that remains elevated even as the labor share hits new lows. If AI continues to drive the labor share lower, this imbalance will likely grow. A workforce with a smaller share of national income can support less consumption, mathematically requiring the public sector to borrow more just to prevent an economic contraction. The rise of AI and the decline of worker bargaining power are structural forces rewriting the mathematical balance of global wealth. As income shifts from payrolls to capital, the system creates a widening void that is increasingly being filled by national debt.